Money Show. Personal finance.
Warren Ingram with us this evening. He's on holiday, but if you're a financial advisor, if you come onto the Money Show, there's no such thing as a holiday. Warren Ingram is director at Galileo Capital, and he sounds like he's in the back of Beyond. Earth to Warren Ingram. Are you with us?
I am, and I am kind of in the middle of the country.
You are slap bang in the middle of the country, as far as I understand the country. Now, listen, Warren Ingram, we asked people for questions, and Leo, I've chosen a couple of Leo's questions because they seem to be the ones that would get the broadest level of interest. And a very simple question, or simplistic sounding question, but one that needs an explanation, please. What on earth, asks Leo, is a money market account?
Yeah, it's a good question. It's a little bit of background. When you invest your money to earn interest, you normally can get it in one of two ways. One, you can go to a bank and you can say to the bank, I'm going to give you my money and you're going to pay me a rate of interest until I want my money back. And so the only thing that happens there is your risk is really the bank. If they fall over or they go bankrupt, then you might not get your money back, and if they can't really perform properly, you might just get a limited amount of interest. But it's a straight transaction between a depositor and a bank.
Now, and that an ordinary bank deposit, the theory goes, you put money into the bank then uses that money to lend on to somebody else at a much higher interest rate. And their profit is the difference they pay you and what they charge the customer. If they make good loans, you get a decent return on your money.
Exactly, and they'll often do it as it could be a current account or it could be a fixed deposit where you invest your money for 30 days or 90 days or even up to a year. And as you say, then it's up to the bank to do its job, and it might even promise you an interest rate as well, and then it's really up to the bank to make sure that it delivers that on that interest. So essentially you get a guarantee, if you will, from the bank, and it's you take the risk of the bank doing its job.
Now, a lot of people treat money market accounts like fixed deposits, but they're not.
No, and you get two kinds of money market accounts. You would get an account at a bank, and then you would get a money market unit trust, and the difference is very small, but there is a difference. So typically, what happens let's just start with the money market unit trust, because that's really where the bulk of investors would put their money. What will happen there is that the fund, the unit trust fund, will actually end up owning a range of different investments, all based on very short-term money market instruments. So these are typically things where, let's just say, a big bank, a big corporate. So Anglo American says we're going to issue a 30-day instrument where we're going to borrow money for 30 days, and if you give us that money for 30 days, we'll pay you back your capital, and we'll also pay you an interest rate which will work out, for example, to 9% a year, but obviously it's only for 30 days. So it'll be 365 days divided by the 30 to give you your interest. 365 days.
Don't tie yourself in knots now, Warren. I know you're on holiday.
Yeah. So essentially, you'll get your interest back from them. Now, what happens is they'll actually issue an instrument. So it's usually they're called money market instruments, and they have a range of different lengths. So you can have one that's only 30 days up to 90 days or half a year, etc. And a money market fund will buy a range of those different instruments to try and get the best rate of interest as a pool on all of its money together. And then it will pay out investors that interest on a regular basis.
Now, for anybody who believes that a money market investment is as secure as a deposit in the bank, you only have to cast your mind back 18 months to when African Bank went bust and how a portion of money market investors' money was lost forever. I mean, there is that risk, and that's why you do tend to get a slightly higher return in a money market investment than you do in a fixed deposit, right?
Exactly. So if you have a risk spectrum, then your money market fund is sort of a notch of risk higher than your fixed deposits or your bank account deposits, but it should then pay you a better rate of interest. And to be fair to most money market managers over long periods of time, they have certainly done that job. And the reason why they're not as high risk, for example, as what they call income funds, is simply because the instruments that they're buying are very short term. They literally last 30, 60 or 90 days as a general rule. And then the fund will also have quite strict rules about not being over-invested in one type of instrument or with one institution. So there's quite a big spread of investments that you go into. So I think, just to understand, yes, there is a little bit of risk, and certainly there is capital risk, and also the potential that you might just get a lower rate of interest on your money. But we're certainly not talking about very high risk investments, and losses are generally unusual.
The blowout at African Bank was incredibly unusual, as you say. Right, now, says Leo, he says, I've Googled and I am confused. You and Wandering Warren, he calls you, because he knows you're on holiday, always say keep 3 to 8 months' salary for expenses. Now, I've never said that before. I've said it may be sensible to keep up to 3 months. I don't know where he gets the 8 months, but you put it's the sort of place where you might store your emergency fund, however much money you think you need to survive in case of, I don't know, you break your ankle and you can't do your running job, or you lose your voice and you can't do your talking job, for example.
Exactly, and I think Leo is probably thinking about me, because I have often said 3 to 6 months is a good number. 3 to 6 months of worth of expenses in a money market account. And I think the difference between a money market account, why it's good for an emergency fund, is because there's no notice period. If you've got an account sitting at the bank and it's linked to your banking profile, then that money will be in your current account within 24 hours at most. Whereas if it's in a money market fund, in a unit trust fund, it'll probably take 2 or 3 working days at the absolute most. So you don't have a contractual term like a fixed deposit or a notice account where you might have to wait 30, 60, 90 days or even a year before you can get your money, or if you want to access it, you have to pay a penalty. So it's ideal for an emergency fund, but not really a great place to store money or to store your capital if you've got 3 or 4 years to save, because you're not really going to do much against inflation with that money.
Okay, so I think we've done money markets. Now, what is the difference, asks Leo, because Leo's been very greedy. He's squeezed in 2 questions, which I liked. What is the difference between ETF products? He says, the internet tells me that Ashburton's Top 40 one achieved slightly better returns than Satrix's. Now, fees aside, how is it possible, since they're all the same Top 40 companies? Explain that one, if you would, Mr. Ingram.
Okay, so we can't say fees aside, because that certainly is an extremely important factor in the difference between the various exchange-traded fund providers. But I think we just need to understand the costs, and then also the skill of the exchange-traded fund provider does play a big role here, and then how they limit transaction costs. So let's just start with the fees. Certain exchange-traded fund providers, for example, would say it costs us 0.4% per year to manage your index fund. So yes, we're going to replicate the top 40 shares on the Johannesburg Stock Exchange, and we're going to charge you 0.4% per year to do that. And that's the fee that gets paid to the fund manager to provide that product to the market. Whereas another provider, and I think Ashburton's a good example in this case, would do that at a much lower cost than the rest of their peers. So they're obviously hoping that if they do it at a low fee, they will get more investors to go in. And so they might come in and say, okay, fine, we'll do it at 0.2 as an example. So that annual fee is the one reason why the funds won't perform exactly the same as the actual index will perform, and they call that underperformance a tracking error. But then it comes down to another thing, which is then the transaction cost. So every time there's money coming into that exchange-traded fund, the fund manager then needs to take that money and actually go and buy the 40 individual shares in the most cost-effective way possible to make sure that they keep tracking the index. And if they get a small amount of money in on a day, then you might find that they now need to go and buy those 40 shares, and the transaction costs alone might then increase that tracking error. So now you've got the 0.4% that you're paying the fund manager, and then let's say 0.5% of transaction costs, which make that tracking error go up to 0.9 if there's always transaction costs every day. And then we get to the actual skill of the fund manager who's managing those exchange traded funds. And the idea there is that they might, let's just say that they get a small inflow in the day, and they might say, okay, we need to buy the 4 big banks, but actually what we realized is if we only buy 2 of the 4 today and wait for some additional money tomorrow, for example, that the performance will still look exactly like the top 40 index, but we don't have all these big transaction costs. So there's quite a lot that goes into that tracking error on exchange traded fund.
Okay, thank you. And then I've got one more question for you. Thabo on the SMS line this evening is, what should you pay off first? Your investment property or the property that you live in? Putting aside your property prejudice, that is very famous, Warren Ingram. Assuming that Thabo's got 2 properties, one is an investment property, so he's got somebody renting that from him, and then he's got his home in which he lives. Which is the best one to pay off first?
Typically, you actually want to pay off your investment property slowest, because you're allowed to write off the interest that you're paying on that investment property against the rental income that you're getting for purposes of saving tax. So that's a legitimate expense that you've incurred to generate the income from rent, and so it doesn't make sense to pay that off very quickly. It would make much more sense to pay off your home first, because you get no tax breaks on the interest that you're paying there. Of course, the other factor just to consider, I always have to sit on the fence with this, is if the interest rate on your home is lower than on the rental property, you might just want to think about that if you're a little bit under cash flow pressure. So, as long as your budget's fine and the interest rates are the same, then you would pay off your home fastest.
Lovely. Thank you very much, Warren Ingram. Enjoy the rest of your holiday. Financial advisor and director, Galileo Capital. We'll be dipping into Warren's holiday from time to time. We can't let the wicked rest, can we? No, we can't.